Sean, thank you very much for making the time for this conversation. First of all, for those who don't know who you are, could you maybe give a short introduction, who you are, what it is that you do, and especially how did you end up here?
Sure. Yeah. So Sean Emory. I was born and raised out of Miami, Florida. Still here. Founded the company Avory and Company. Sits inside of Miami. We do business all across the country, and in some cases the world. Select markets. But my background in general, again, born and raised here. Played baseball. Played a lot of baseball my whole life. Ended up playing baseball and going to Stetson University. It's in Central Florida. It has a really strong investment program where you're able to run real money and run it in a high conviction way. So while I was there, we were running a high conviction equity strategy. So you can imagine, Avery today is really all around high conviction and fundamental investing. A lot of that came from some of the stuff we were learning there. The head of that, the portfolio manager, I worked at his hedge fund. I was a small cap equity analyst, still learning the trade, and ultimately just trying to discover, find companies that are interesting. From there, I went to a multifamily office in Miami, came back home in a sense, and was able to one become an analyst and then lead an investment team and be the head of investments at that firm. Built out a high conviction equity strategy there, and over time, learning everything from the micro to macro to fundamentals, really having a full exposure there because of the nature of how that firm ran. I just had exposure to everything, but at the end of the day, my core ethos was really around finding companies that had unique characteristics that we look for, and investing behind those and following those really, really closely. So that's what led to Avery's foundation, high conviction investing. Our firm, our concept is investing where the world is headed. We've been around for almost 7 years, and that's ultimately what we're looking for. We're finding companies that are investing where the world is headed, either really creating that path or redirecting their efforts to course correct and better align where the world is headed. So that's our mission, that's our motto, and it's been a very strong time period here at Avery. So
Yeah, sounds great. And if you go back in time, basically, how old were you when you got introduced first to the high conviction kind of strategy, or way to look into companies? Because you mentioned you were playing baseball, so at that time you were
I had to be. What year was that? That was probably junior, senior year of college, right? So, what age would you be at that point in time? Somewhere around like 19, ish,
okay.
20, 20, 21 at most. So it's really that. Even before that, I always in different types of conversations talk about where I at least did the passion for finding
Yep.
and discovering, which ultimately is what like an analyst jobs is.
Yep.
Um, Came through the lens of fantasy baseball. So I still talk about that today. It's the same concept. You're trying to build a team in theory. Build a portfolio of players. You're trying to buy them low, sell them high. Try to find certain characteristics that you look for that maybe allow you to find them earlier or find them when they're starting to decay, I guess, or hit
Yep.
a plateau. So and then assign some sort of value on that. So some of that I that kind of pattern recognition, I think, started even earlier than that. And I just had a passion for it. So morphed that into
Right.
a now half of my life career. So
Yeah. So having a passion for data, for analysis, and especially for finance, it kind of all blends in together. And
yeah.
now I have not been part of an investment firm. For those that are listening, like myself, who have never been part of one, could you share what a day in your role looks like? And especially if you take a look at the last said 7 years, if you take a look at the time before COVID, during COVID, and now after, do you see some change when it comes to your role, how the time is being allocated to different activities?
Um, I'll start with the last part of that, which is how has it maybe changed? And I think the main change was a lot of the conversations that used to happen maybe a little bit more in person are now happening during means of like Zoom and conferences and
Yep.
digital conferences. So whether it's company analyst days or you know the Goldman Sachs technology conference, Some of those were a little bit more in person prior. Now, they have the tools, the technology to allow that experience to be pretty good um, over the air, I guess. So that's a little bit of the change. But if you think of like the day to day, again, it all comes down to the same concept of like just discovering. Ultimately, that's what we're doing. We're discovering, maintaining, and trying to fill up a pipeline where we have a process that we work through. And the reality is, right when you wake up, your day kind of starts. We live in, I live in the U.S. markets open at a certain time, but all the other world is opening.
Yeah,
Earnings are happening at 8 a.m. Some of them happen the night before. So my day to day is really, number one is, you have your preset plan of, what's happening for that week and that day and meetings and things like that. But you also have, your calendar around company events.
of course.
So I'll give you an example of like this week, right? And I've
Yeah,
spent a lot of time listening to Goldman Sachs conference, Citi conference. Just before this, I'm listening to, the PayPal speak at the Goldman Sachs conference. Companies that are affiliated with the companies we invest in, we're trying to understand any dynamics there. So it's a lot of just discovery throughout the whole day in between those cracks of who's
yeah.
doing what, where, and why. That's kind of like a day to day.
Yeah, basically you get exposed to so much information throughout your weeks, not just one day, but if you take a bit of a longer time frame. And I guess one of the challenges is probably figuring out what is actually important, because there's a lot of information out there, and sometimes it's just a bit of noise, and sometimes it's something that you could hear at a conference at another company that is actually relevant for a company that you're invested in, right? Um, is this something that you see as a challenge, having too much information, too much data out there? If not, I mean, are there other challenges that you face in the whole process of managing a company of this kind?
Yeah. Obviously, you can get overwhelmed with data. And I think that's the beauty of running a high conviction model, which is, you know, when we invest, we're trying to find companies where there's some data points that we can extract and use as almost guiding guideposts along the way. Whether it's app downloads for a certain company, web traffic to a certain company, looking at we just had our investing with data newsletter on Fridays, but it was essentially, I'm just giving an example, but Instacart's about to go public, and Instacart's app downloads track their
Yeah,
gross transaction volume pretty closely. So um, that's obviously informative data. So it's understanding what you're trying to look for, and you also want to look beyond that, right? And kind of have your core of what you're looking for, and then have the opening for new information to creep in. Whether it's PayPal talking about Venmo because you invest in Block and Block owns Cash App, seeing
yeah,
what they're saying. Some of it's quantitative, some of it's super qualitative, and yeah, I mean, you can get overwhelmed with data. I think when you make an investment or you look at a company, just designate what you're looking for and what could be interesting for it. Otherwise, you're either
yeah.
wasting time or you're getting information that doesn't even,
Yeah,
really
I
mean
agree.
much to the core. So
I agree. And what you mentioned, the app downloads, that is really kind of an alternative method to get some insight earlier before the public data is out there, right? I mean, it is one of the many things. I'm sure that there are plenty of other kind of alternative research methods that you find useful. Could you share a bit more about that? I've seen that I mean, you're active on social media, you share your findings, you share your thoughts, and I think that's interesting for someone like me. What are some alternative methods that you find useful? And of course, I understand that these are not the starting point and the ending point for deciding whether to make an investment. It's just some supporting information to use along the way.
yeah, look, we allocate a lot of our budget towards trying to find data sources that matter to the companies we invest in. So look, if you're investing in a portfolio of companies where, a good amount of them have, apps, and those apps, are really critical to, the business,
Yeah,
then things like app downloads, app engagement, web traffic, you can go beyond that. You look at things like, foot traffic, where again, we just shared how many people are going back to the office, and foot traffic towards the office. That tells you a little bit of something about, where are we in terms of, again, as you were saying before, post COVID, what's the new normal and what does
yeah,
that look like? And how many people are going to go to the office? 70% of people are in the office or 65, but there's still 35% of, traditional foot traffic that's not coming back. So is that the new normal, or are we still going to creep higher? And we do a lot of also, very hands-on, things, which is, going to the CEO of a company's LinkedIn and just seeing all the stuff he's liked or she's liked, comments she's making, and just trying to see if that tells us anything about anything. Who are they following? Who are they unfollowing? You can't really see unfollows, but who are they following? And so those are some of the different data points. So you have like your core data points that you're trying to track and observe. And then you have some of the extra stuff that you're also trying to track and observe. And, ultimately the goal isn't to figure out, are they going to beat or raise, this specific quarter? Obviously, if you can figure that out, great. But it's more directional. Like, is the thesis you built out directionally still on track? Or is something changing, and is there evidence, that supports one way or the other? So that's kind of how we think about it.
Makes sense. Speaking of LinkedIn, what are your thoughts on job openings? If a company has a lot more, could that be a signal that maybe they're expanding of some sort? Because in theory, obviously there's an argument to be made, but it it's not that difficult to fake these kind of postings, right? Just post them and not do anything about them as well, right? So is there are probably some sources that are generated from the company that are difficult really to verify. So it could be a double-edged sword in some way.
Yeah, like, so job postings on LinkedIn, um, obviously that's a data set. There's also job postings on their website that you can track and scrape that and essentially see. I think there's really two elements to it. Number one is, are they increasing their amount of jobs? That is generally seen as constructive. The reality is if you the last 2 years that hasn't been necessarily a good tool. Why? Because obviously jobs have been in flux. So you
Yeah.
have companies that are
Yeah.
trying to raise profits, so they slow down their hiring. And ultimately, what you're actually seeing a rise in profits. So maybe it's signaling less revenue growth or acceleration, or maybe not. Because some of the spend over the last 3-4 years have been incremental spend, trying to for future growth as opposed to growth today. So it hasn't been as reliable as an indicator. We did spend a lot of time, pre, 2-3 years ago, really looking at job openings as a sign of strength or weakness, because the world was a little bit more normal, and things were a little bit more even. Today, I think that's a little less reliable. And then the second part, I think, is how we're looking at it today is, if they are hiring, where are they hiring? Is it sales reps, engineers? Is it, generative AI? It's really trying to understand what they're hiring for, where they're hiring. That is giving us more insight today than just the sheer number of opens or closes. So
That makes sense. Thank you for sharing that, John. And if you take a look at your company, Avery and Company, could you share some information about the investment philosophy behind it? Kind of a high level
yeah, yeah, I'll give you our
investing
like
where the
our
future goes.
small large in elevator pitch, right? But
Sure.
no, it's generally okay, big picture, investing where the world is headed. That's been our DNA since day one, since pre-COVID. Before that was
Yeah.
a popular thing. But investing where the world is headed, and ultimately what that means for us is, we really think companies have a maturation cycle. They go through a cycle. They are the, I don't want to say disruptor. That word gets used too much, but they are the ones really identifying the path of where the world's going, building their business along that path. Shift from like physical finance to digital finance. That's like one element, and the company's building that path. As they mature, they go through, their growth phase. They can be growth and profitable at the same time, but they go through their growth phase, and they eventually reach, some sort of either saturation or maturity plateau. And in some cases, they become somewhat stagnant and, have this kind of like innovator's dilemma. And ultimately, the goal there is to invest where the world is headed, but realign their efforts to where the world is headed. So an example is like Microsoft in 2014, 2012. You think of, Adobe shifting from a, license, give us all the CDs, to shifting to a subscription model. And ultimately what that did was realign to where the world was going, to subscription models, pay as you go, cloud native. and that totally transformed the model, reignited growth. So what we're trying to do is find structural growth companies. We designate around 11, 12 every 18 months, everything from automation to digital work today to the future of education and some of the cost burden there. And then on the other side are transformation stories. So like to big picture is structural growth side. That element for us is our companies that are really have identified where the world's going and building product towards that. And then transformation are the companies that are transforming their business to better realign to where the world is and going in the future. And those are two different beasts in a way,
Right.
because one's like more growth oriented and the other one's a little bit more transformation, transition. But we think that's the two sides of the equation where growth tends to be underestimated. And there's a little bit of a dislocation in those valuations during those moments of time. So that's how we
Yeah, and
think.
if you're right in those companies, obviously the return is quite significant. And there's always this discussion of, especially when it comes to companies that have reached this plateau, when they're considered cash cows, they're generating significant cash flows year over year, and then the dilemma is, do we pour a lot of that cash to try to reinvest, kind of reinvent ourselves and come up with something new and basically disrupt ourselves, or do we return that cash back to the shareholders? And from a shareholder point of view, it's do you want something safe? The cash is there. Do you want to just take it out? But that means there's a risk that the company will get disrupted by someone else. Um, and of course, there's always the risk that they reinvest and doesn't turn out well. I mean, there are plenty of companies that have done well and plenty that have failed. So it's not an easy task to do that. But of course, if you spend your time, if you do the work, then at least you increase your chances of having success in that. And if you think about the investment philosophies, do you think that it's very important for a retail investor, for example, to have one? And it doesn't have to be maybe as clearly defined. At least the way I look at it is, it's at least important to know what you have no clue about. Like, for example, um, I have very little knowledge when it comes to biotech companies. I don't know a lot about the drug process. I don't have enough information to understand how that works, to assess the chances of success. So for me to focus on that would be just a waste of time, and I can never have a good understanding of that. Just because, yeah, look, that's not my background, and I'm not looking into that. So do you think that at least defining what you can look into, what you have knowledge about, is useful? And how, I don't know, what would be your advice for setting an investment philosophy for a retail investor?
Yeah. So first off, there's obviously a lot of there are sophisticated retail investors, and if we're defining retail as just like size of dollars, you can find a cohort of retail investors that are sophisticated, savvy, and love to do it, and probably should be professional investors at different organizations. But then there's obviously 95% that aren't necessarily specifically educated or spend enough time in the space. What we do is, so we have, I think it's important to have a well-defined process at the end of the day, like regardless of who you are, what you are, like you really have to define what you're looking for, what you're not looking for. We take like we'll have like a summer intern, and, we'll take them through a little like kind of investment questionnaire, which is really just, who are you? What areas do you like? What you don't like? You want to spend time in areas you have appreciation for. That probably makes a better, investment analysis discovery process for you. Number one. Number two is, what areas, like what's your strength, what's your weakness? Maybe you spent a lot of your life without even thinking about it. Maybe you worked as a retail person at the front desk at, I don't know, a Abercrombie and Fitch. So you have a decent idea of like how it at least functions. And then, like you said, I mean, we're in a similar boat where we try to stay away from, some of the pharmaceutical, areas, just given that it's not our specialty, it's not our core. There's so many companies out there, big, small, all shapes and sizes that we can invest in. And again, when you invest with high conviction, we only need, 15, 20 companies,
Sure.
12 companies. So I think having a well-defined process is super important, understanding where you want to go, where you want to be, and then the workflow. I think, you want to be able to walk through a company once it's presented to you in a similar-ish way. It could be a different industry, but similar-ish way of going through, who the management team is, how do they operate, how are they compensated, things like that. What is the business model? Just make sure you understand it. And then going beyond that to like valuation and such. But I think it's important to have a process for sure.
Sure. Well, speaking of the process, could you share some of the steps that you take in the process of researching a public company? Kind of a high level, of course, not really detailed, but what are the important things that you look into? You've mentioned a few already: the management, the compensation, the business model.
Yeah, I think product is ultimately everything. A lot of people spend a lot of their time early on and looking at financials. We spend very little at the onset looking at financials. Those can be figured out over time if you have a product that creates real value. Again, at the end of your analysis, obviously the financials matter a lot, but at the beginning it's really around product. So like we try to immerse ourselves in the product, and have a good understanding of what it is. If you understand the product, you understand the core value that it's driving, you can then try to understand some of its competitive advantages or not. And it probably allows you to understand the competitive dynamics that it has, other companies as well. So we spend a lot of time and effort up front with product, spending time on their YouTube pages, their Twitter pages, and all this other stuff of just trying to understand, who they are, what do they do, how do they go to market. So that's like really the discovery phase. And we have, without going too much, it's discovery, follow, focus. And the discovery phase is really around product. The follow phase is now you're spending a lot of time and energy trying to go through everything I just said, who the management team is, how are they compensated, what have they done in their past? Are they aligned with us as investors, them,
Sure.
the board, everybody? And then again, business model. Do you understand this business? And I don't mean like, Apple sells phones, but it's like, Apple sells phones that are manufactured in China, and now China is doing
Yeah.
this.
Exactly.
Those are all risks. So, the last two steps really are not the last two steps, but, two important areas as well are, the market they play in. Make sure you understand the competitors, because ultimately, I'm listening to PayPal or I'm listening to some others to understand, how they impact maybe a company we're invested in. So, and then lastly is valuation. So you're trying to triangulate, what's this thing worth? But you got to do all that other work first before you can't make a valuation of anything without understanding all the
I
dynamics
agree.
before. So,
I
um,
agree. I agree. It's you cannot even. Where do you start valuing a company if you don't really understand it? You have
sure.
there. There's zero chance to make any assumptions that are rational. You cannot
Right.
back them
Right.
up. So, um, no, I mean, I follow something similar. Of course, not maybe the same approach that you have, but I do cover a lot of those things. I do think it's important to understand the company. Ultimately, the way I look at it is the company is the employees and then the product and service. You need to
Yeah.
have both being good, satisfied employees, and on the other side, great products and services. If one of the two is not at an acceptable level, then there's no business, at least not in the long run.
Definitely.
So it makes sense what you've mentioned. And how do you find interesting companies initially to at least to find and then to further look into? Do you use some screeners? Is it
Yeah. Again, I think it's really defining the areas you want to play. We defined ours, right? So, like, this will give you a good example, which is again investing where the world is headed. Those two sides: secular growth and transformation. That alone, right? We know we have these blocks that we're going after. Whether it's the future of education, meaning education, where's it going, where's it headed? We think there's a lot of cost overruns. Same in healthcare. Are there areas of healthcare where costs are so elevated? The average spend per capita in the U.S. is 12,000. The next best country is 6,000. There's a lot of wasted capital that's out there. Are there companies that are developing tools and products and creating value that then they can extract that value? Digital work, obviously, that changed a lot after COVID. You think of automation. Automation's been a theme for us for the inception of Avory, and it's really around a lot of all the mundane, wasteful time that we all spend doing things. How can you automate your way through that? Obviously, generative AI is supercharging some of this effort, but as long as you have an idea of like where you're trying to land, you can think of like UiPath is making robotic process automation, which is automation. You think of Smartsheet and Airtable and some of these other companies, public or private. You can quickly discern some of the companies that exist. So that's like I think that's like the foundation of how we idea source secular growth transformation. We have screeners. The screeners aren't your traditional screeners. We're actually trying to look for companies that screen very poorly, that the average person may not be looking at. So like positive operating cash flow, negative net income. That's
Sure.
usually a subscription model that's maybe growing fast. IPOs, when they come public, we'll watch the road shows. It's been not that busy over the last year and a half, but
Yeah.
we want to watch them as they enter the market, so we have an understanding of like who they are before they, maybe 5 years from now we invest in them. Maybe it's 3 months we invest in them, but
Yeah.
so that's kind of like the areas we do to identify opportunities. So
Yeah, and I think it's kind of you build a database of knowledge about companies that maybe are not great investments at the moment, but as you mentioned, you never know how things will turn out. And I've been asked that question um, a couple of times, like, why do you share valuations of companies that are overvalued? Well, I don't know that at the beginning. I know that only at the very end. But at that moment, at least I know what I consider at least fair value. From then on, it could be that the price goes down, could be that the price goes up. I don't know what will happen, but at least I have enough knowledge built, and if there's opportunity, then I can act upon it. And you've
definitely.
mentioned 12 companies, 15 companies, 20 companies, right, depending on the portfolio. It is not a very large in terms of number of companies within. What are your thoughts on diversification, and in this case, what is your approach?
Yeah. So we always turn the history like back and look at Warren Buffett's quote. Put your eggs in one basket, follow that basket closely, and ultimately, for us, that's how we think. We think actually, there's plenty of studies when you go back in history and you look at what a portfolio looks like from a non-market risk perspective. You mean how much non-market risk are you taking? Single idiosyncratic stock risk. One, two, three holdings in a portfolio, risky. It's been proven out over time. As you start to get to 8 to 25, which is where we sit, you start to get to a much more flattish non-market risk exposure, where ultimately we think is the sweet spot for diversification, where you're not taking enough concentration risk, where if something blows out, you're in trouble, and you have enough exposure to withstand that. So it gives you the opportunity to generate alpha, but at the same time diversified enough. Ultimately, we think risk is like the quality of that asset. So if we can stay on top of this company, follow that company closely, hopefully closer than most, we can identify, when something's fundamentally changing about a business, hopefully ahead of time, and we can get out of the way if there's, risk being presented. Our thought on risk is permanent loss of capital risk. Is there permanent loss of capital risk threat here? If so, things change. If this is just, a moment in time and valuations, are getting skewed by, other factors, that isn't permanent loss of capital risk. That's, the market's being,
Yeah.
you know, a voting machine in the very short term, and we'll see what happens over the long term if they continue to execute. So that's how we think about,
Mhm.
concentration and risk.
Yeah, and speaking of valuations, of course, the interest rate changes have an impact on the valuation as well. It's a kind of a macro data. Do you find some macro data relevant? How much of a role does that play in your investment decisions and when you track them forward?
Yeah. I mean, we definitely look at macro data. We're definitely, when macro comes out, the story is constantly changing, whether it was like, tariffs years ago, which is macro oriented, or, liquidity coming into the markets versus now liquidity coming out of the markets. Again, we try to just identify, what is important in that macro at that point in time. And where are we in that, like that cycle? So, you look at inflation today, how can we track it in real time and have good oversight? What is ultimately that feeding into, the Fed's decision-making process? What are they looking at? Because ultimately that's what matters if the Fed's, rate hikes are on the table. So, we have, we are a fundamentally, stock pickers, bottoms up firm, but we also are very coherent and, provide a lot of insights and data out there around the macro from our point of view. And we keep it simple. We focus on the consumer, the health of them, the housing market, biggest asset, biggest liability, typically for
Yep.
somebody. Today's flavor of the year and last year is inflation, so that's more top of mind in terms of tracking that and the Fed. But it'll constantly change. We think it's important to have a good grasp of what's going on, because that could, again, permanent loss of capital risk is what matters for us. And, the macro is there. We never really make decisions specifically on the macro. Yet we are highly informed of what's going on and just making sure there's not permanent loss of capital risk to our underlying securities
Okay.
because of the macro. So,
Okay. Makes sense. Well, you've made quite some decisions, I'm sure, throughout the last decade or so, even more. What has been your best and what has been your worst investment decision? And maybe if you could share what went right and what went wrong in this case.
sure. Um, so two that come to mind, or even like one of each, and even like I'll throw um, two negatives, because sometimes that's where you can learn the most in general. So like, ironically, and I'm just thinking about it now, they all start with a W somehow. And one two negatives is one was Whole Foods, actually. So we owned Whole Foods, and we actually never lost like really any money in it, or anything like that. It was just it was more the thesis, right? So Whole Foods was, they controlled the very, call it high end of mass grocery, with like 3.5% margins, right? So we knew they had this, uh, dominant position within that category, and it was showing up in the margins. And they decided to, and thoughtfully, really try to create a larger store format of 365 by Whole Foods, which is their private label version, trying to make it more affordable and accessible, and have more locations across the country. And I remember vividly, the excitement from management, and this is again staying very close to the management team, listening to them, not just reading the transcript, but listening to their tone. Where they sounded very excited. They launched a pilot out in like Seattle or something, or Portland. I'm just trying to remember exactly because now it's been a while. And we started to look at the health of those, meaning we're looking at the Yelp reviews of the first location and some of the Google, reviews and stuff like that, just to try to get some information. They were coming in at like 2.5 stars, 3.5 stars. But then you started to hear the tone of the management team start to change in terms of the level of excitement. We actually, that was the growth story. That was going to be the growth story for this. And health conscious consumers were, continues to be today a secular trend. And so they launched that, and we got out of that thinking the growth story was somewhat capped here. It was maybe just I forget the exact time period, but then 3 months later, Amazon stepped in and acquired them. So it was kind of like it validated what we were looking at in terms of the value of that asset. Amazon saw the value of that asset and obviously acquired it. We weren't in the name at the acquisition. So there's that. Number two was I guess the company called Wish, right? So like a couple years ago, here's a company that was the number one shopping app, almost like Temu today. And they ultimately, there's a lot of good reasons to like them. One from a balance sheet perspective, two from a growth perspective and global opportunity perspective. The thing that they ran into was IDFA. This was more of a idiosyncratic event for them, which was really around Apple's change of IDFA. It was sudden. They marketed. They had most of their advertising on Android,
Hmm.
and what you saw was the cost per impressions on Android skyrocketed higher, and they this is basically the dollar store of the internet. So like if the cost to acquire a customer goes up dramatically overnight,
Yeah.
and then the supply chain and planes weren't necessarily traveling, and most of cargo, like a lot of their cargo, goes through the belly of a passenger plane. So
Yeah.
their supply chain, the cost of getting the goods was going up, the cost of acquiring a customer was going up. What we saw though, and this is what protected us from a calamity, because again, the company eventually like transitioned completely. We were already out of it, but it was what protected us some was we started to see app engagement and app downloads plummet. And
Hmm.
basically, they turned off their. We didn't know at the time the reasoning behind the drop, but it was concerning because you don't see that much in the data that we use. And so we took a lot off the table, and it's sure enough they shut down their ads, like trying to acquire new customers because everything I just mentioned. That was an example. Last one is a win, and we have plenty. Like we have a good amount of those, which is good. But the Wix was one of my favorites. Wix.com, which I've owned even prior to Avory, really around the IPO, which is it's just been incredible to watch. A company come at it with a singular product and evolve so rapidly with the same exact team that existed then to today. We were investors then, prior firm, start of Avory, post COVID. We actually sold it because it rose so dramatically during those times, and back in it for our second go round because of some of the depressed valuations out there in the marketplace. So that's been a very successful, amazing one to watch of how you can take a single product and continue to evolve and acquire new customers, and it's really a secular trends. Like when you do invest behind these secular trends, you have this ability for a company to just continue to expand and compound on itself. So it's just been incredible to watch.
Yeah, and Wix I think has a very simple offering as such, but it solves an important problem for and it solves it in a very easy way. So definitely a lot of value. So not surprised it translated, of course, into the value.
Yeah.
Um, and which company has surprised you the most? It could be both positive or negative. Obviously, the events that you mentioned, if it's COVID, for example, I mean, these are not events that anybody could predict, or changes in whether that's Apple Pay or maybe, well, those someone could predict, but not someone from the outside, of course. Is there anything that comes to mind?
That is surprised. I would say like it kind of comes back to the idea of Wix, but I'll share it with another company very similar, which is like Square. It's just the ability to like take something simple and expand it. And we've again owned Square for a long time, and similar trend with Wix, which was owned it pre-COVID, sold it at the hype cycle, and then it came back down to us, thankfully, to get a second go round with it. But it's one of those things where early days of investing it, this was a point of sale platform, and they were selling point of sale, and it was really a dongle on a device that then morphed into the actual like white point of sale sitting on the as a cash register. But today, 55 million Cash App users. All of that was organically driven. It's been incredible to watch like how they've been able to take a one solution and innovatively, create a whole another side of their platform. And it's just one of those things where some of the best companies' investments over time tend to look totally different than their early days. And that's ultimately what it comes down to. Like Apple sold a computer, now they have an iPhone, that and AirPods and Apple Watch and things that like the rational person 20 years ago never would have even one
Sure,
imagined, but two would have said that that was part of their long term thesis. So
for sure.
so it gives you that it's why buy and hold tends to outperform some of the other stuff, because the best companies are constantly evolving, constantly investing where the world is headed. That's
Yeah,
why we have that concept, which is these companies have to continue to evolve, and that's what creates compounding of these assets, as opposed to no one does the same thing forever, unless you're like a utility, and even that can be competitive,
yeah,
right? Where solar
for
is
sure,
putting them on their back
for
heels
sure.
right now. Um, so yeah.
For sure. I was thinking about Zillow. I saw your post recently, and it's an interesting example of a company that tried to do something different on a large scale recently. A couple of years ago, with the home flipping business. I'm sure you're aware of it.
Yeah.
Um, my initial thoughts were, if someone can do it, then it has to be Zillow. They have the most data points. They know where all the homes are being sold, the prices. They literally have all the data. I mean, I don't think there's any company that has as much data when it comes to real estate than them. And flipping homes is a it's not a high margin business, right? You can get 10-15% maybe. That's before taxes, before all the transaction costs, if you're lucky sometimes, right? At least in a short period of time. So I'm wondering if for example, we go back in time and you just heard the decision, hey, Zillow is going to take this decision, they're going to try to flip homes. What is your thought process? Do you think, well, it could be successful? Do you think it's way too risky for them? Of course, the real estate market can go both directions. A lot of the homes have been financed, so there's a lot of debt on the balance sheet as well. Just trying to pick your brain to see how you think of.
Yeah. It's one of those things where I think what you just mentioned in terms of their position in the market, allowed them to, go after the opportunity. Their balance sheet, their cash flow allowed them to go after the opportunity. Um, and, you have a management team, that has executed wonderfully throughout their history. So they have you know, not only did they, start um, Zillow, but, there was, I think it was Glassdoor, right? He founded Glassdoor. He
Yep.
also founded
Yep.
Expedia, right? And he was on the Expedia founding team. So here's somebody that knew how to create, like digital marketplaces really well. So I think he earned the benefit of the doubt to go after this. Um, he also earned the benefit of the doubt to shut it down when he felt uncomfortable with the size of capital that was required to get
Yep.
this to the next level. So that was it. I think, yeah, that's an interesting area. I mean, you have to think about two things. Number one is it allowed them to not only potentially own the entire transaction, go from, selling the home to buying the home to attaching mortgage to the home and all the other extra services that can go attached to that. But it also, at the very least, even if they didn't buy or sell that home and flip it, they got a whole nother side of data that they have never had. So Zillow's known
Sure.
for being a buy side platform where you're most of the traffic that comes to their website and their app is buy side traffic, meaning you're looking for a home. And this was the first time that they would to have access to signal on the sell side of a home, someone looking to sell who eventually is a buyer, right? And that unlocks the whole other side of the market, which is why they eventually, shuttered it, but then partnered with Open Door. So you can click cash offer in Zillow now,
Yep.
but Open Doors at the like actually doing all the work. But now it shows Zillow who's a potential seller, which means a premier agent can now assist with that and now win both sides of the transaction from a commission standpoint, which ultimately feeds back into Zillow's revenue stream. So that's ultimately, why there was the importance of going after this. You wanted to get the whole other side of the market. And I think net, it was a good experiment. Now they know a lot about the sell side of the business and that side of the equation. And I think they're, big picture, they're probably better off that they went down that rabbit hole and, came out of it with a ton of capital now, $3.5 billion of cash on the balance sheet. And, a lot of exposure and knowledge that came with that side of the business. So.
Great. Thanks for sharing your thoughts. It's definitely interesting to hear how you think about these kind of topics. And of course, I'm an investor myself, classified as a retail investor. What do you think is the biggest mistake that an average retail investor makes? You mentioned earlier maybe not having enough education or background to really understand what is going on. Sometimes not having enough time to put in the work. Do you think that is what really drives? Because obviously, and it's not only the retail investors, even most of the institutional investors are underperforming the market. So, what do you think is the reason behind that?
Yeah, I think it ultimately comes down to not doing the work. It's hard. I mean, it takes a lot of time and effort to do this
Yep.
stuff, and so I think if you have a full day job and you're trying to do this as well on the side, I mean, that's pretty hard. Um, and also, I think early on, a lot of people try to hit big grand slams, um, and trying to shoot for the stars and try to turn a dollar to a million. Um, and it's probably better. They're probably better off like just starting with the highest quality and work your way down as you start to like become more understanding of how it all works, as opposed to oftentimes you see people and I know friends that aren't in the industry that will start off in like penny stocks and very what you would say cheaply priced like lower price stocks,
Sure.
thinking that means they own more of an
Yeah.
asset, which it has nothing to do with that. um, And so, I just think that's those are some of the, I think, just the general mistakes people make,
Hmm.
even firms, right? I think a lot of firms, sometimes you speak to the analysts and, you know, um, are they doing enough work to really, you know, understand the businesses? Because that'll help you get into stuff maybe when they're attractive, but also get out of stuff before
Sure.
things start to unwind. So I think that's ultimately it, and sticking with those winners that are actually compounding for you. A lot of people get out of things, so they're never smooth rides. I love the stat of Amazon. Every year on average, since its inception, it's fallen 30% on average. I mean, that includes here recently in the last couple of years. I think
Yep.
Netflix has the same characteristics. Right
Yep.
now, like you look at Disney, they're in a 60%, almost 70% drawdown, the
Yep.
second most ever. And you ask the question of like, is that opportunity? So sticking with some of these
Yeah.
stuff are interesting as well. So that's how I think about maybe some of the mistakes or some of
Sure.
the process around retail.
And do you think that, of course, a retail investor that has enough time has advantage over an institutional investor? I mean, I've spoken to a couple of high level, let's say, executives, but also with people within investor relations, and they are the ones also that have these connections with a lot of investment companies. And sometimes, and this is I've heard this a few times, but it's everybody says that they have a long horizon for investing, but that depends on their clients, because if their clients say, hey, we want your cash out, you don't have any horizon, right? So a lot of institutional investors have certain constraints. They cannot make the same investment decisions as a retail investor because, well, if something goes wrong, it seems very bad in the short run. Even though they might be right in the long run, they have this constraint that if the clients pull the money, that's it. So do you think that from that point of view, at least retail investors have some advantage, that they have control over the time horizon, and or do you think that it's not as relevant, at least from your point of view?
Um, so to your point, I think the the most important thing is like, does the investment firm have alignment with the underlying investors? Like
Yeah.
for example, like I am fully invested in our strategy, right? Like that's where all my capital is, right? So that shit validates the view of whatever we're doing.
Sure.
And when I say long term and something's in a drawdown, like we truly mean it, because not only are they feeling it, I'm feeling it, and we're feeling it as a firm. Now, so there's that aspect of, I think, alignment's important. That's where maybe you'll have a retail investor that's they're investing their personal capital, so they're fully aligned with whatever investments they're making. Um, I do think the retail investor, from just a sizing perspective, and that doesn't even just flow to retail. It's like smaller emerging managers, or even just managers that aren't Warren Buffett sitting on $300 billion of capital. Like, he only has so many opportunities he can actually invest in that are going to move the needle for him. So I think, like, if we're talking about that extreme of institutional capital, I think that's where there's definitely an advantage for somebody that's managing less. Um, Also, the it's funny because last year was an interesting year where a lot of the data we were tracking, and we have the capacity to get the data, right? The retail investor doesn't, for the most part. Um, and some of the data points we were seeing were actually constructive, and that keeps you in the markets, right? Constructive data, the fundamentals aren't necessarily changing too much underneath you, yet the stock prices were moving pretty dramatically. Um, and somebody that doesn't have the data, I've been saying, which is like, they'll get spooked out, and like a year like last year, getting spooked out very early would have been like lucky, that you would have gotten spooked out, while the whole time the data was remaining like pretty constructive in different areas depending on what you're looking at. But so that's ultimately how I think about, there's little, I think that's like a here and now advantage more so than like a structural long-term advantage. So that's really how I think of retail, institutional, things like that. But being aligned with the investors, I think, is ultimately what what does it? One other anecdote is, Bill Miller, obviously he's one of the best investors of all time, and even, still today. And he even says like his average investor throughout his career has meaningfully underperformed the actual strategy. And the reason behind that is, when he does really, really well, the investors tend to add more. And when the fund is down, like he's had like 50-60% drawdowns. This is one of the best investors ever. He's
Yeah,
had 50-60% drawdowns, and that's when you should be investing, in there. But typically
sure.
that's how you would outperform a strategy.
Yeah,
But what you tend to see is, the opposite of that. So retraining, I think, the the mindset. If you trust the process, trust the strategy,
of course.
you invest when things get tough, and ask questions when things are going up. So
Yeah, no, I agree with you on the part that there's a lot of focus on the price movement and not so much on the fundamentals. And ultimately, eventually, the fundamentals will catch up. I mean, the price will catch up to the fundamentals. So focusing on the short-term price movement, and this is what I find sometimes annoying that I see on a lot of social media. Oh, the S&P 500 is up 2%, 1%. I mean, just zoom out. It's there's no point of discussing this. And even sometimes I look at the quarterly reports. There's I think there's a bit of noise when there's a, and I think you also mentioned it recently, when there's a change in what they expect for the next quarter or next year, but they change it so little. But they could say, oh, we expect much better to perform much better, and then the change is like 1%.
you're talking about
So
restoration hardware, huh? I just
yeah,
yeah.
yeah, I mean, ultimately, it's maybe it helps to create a bit of a positive sentiment, but if you take a look at what's actually changing, barely anything's changing, right? So sometimes it seems that the management is also, of course, one of their job is to be positive and to kind of sell the story, their vision. There's nothing wrong with that. But even in bad times, you will see, oh, despite the challenging economic conditions, we did this. Of course, and yeah, it's important to look at the fundamentals. It's way more important than, I mean, the price on its own doesn't say anything.
Right.
After all, we're human beings and we have emotions, so of course there will be a lot of movements. I'm curious. I personally don't do any technical analysis. Is that something that you look into, maybe the volume transaction or any of that kind? Obviously it's not relevant for the long run, but maybe.
At the entry and exits, that's when technical analysis will play a little bit of a role. We're just trying to understand, ultimately like supply demand, and that's what a chart
Yeah,
can tell you. Sometimes it can tell you, there's a lot of demand coming at a certain price. There's a lot of
sure.
liquidations that happen at a certain price. So you're just trying to some of that is algorithmic. Some of that are just how many times have you heard someone say, I'm going to sell it when it gets back to 100?
Yeah,
And some of that happens like that. So it's like it plays a role when entry and exits, but that's about it. I mean, within the once we're in, we're pretty much in. So we made
yeah,
our decision.
makes sense. Maybe there will be a reverse stock split or something, and suddenly it's above 100.
Yeah.
I always like that phenomenon that the price reacts to these kind of stock splits and reverse stock splits, which is completely irrational.
Right.
But of course, there is logic to that. If there is a stock split and the price goes lower, there are more people who can invest in it, who can afford to do that. So naturally, there will be a more higher demand for that. But yeah, to get 3, 4, 5, 6% solely based on that, it doesn't make a lot of sense, right?
Right.
I know that you go through a lot of information. I'm curious, do you have time to read books anymore? And if not, or if you do it, what are your favorite finance, and it could be finance or non-finance related books?
Well, I got some books behind me. We have so I'd say like some of my favorite book. I listen to a lot of things a lot of times now. Trying to be hyper productive. I read when I can. I read a lot more before, and at some point, you have to put stuff in action, right? But it's good to continue to
For sure.
retrain yourself where you think it matters. Well, I'm gonna throw one book out here because now I just see it. Tacopedia. It's a taco book. I love tacos. Totally
All
irrelevant
right.
to finance. But another one here I think is the Age of the Invisible Machine. That came out like maybe last year, or the year before. And it's a cool book, especially now given the focus is around of that book is around conversational AI, and it's about understanding the technology, the negatives, how you plan for it, and how to implement, conversational AI. Obviously, it's a technical book, but it's also really built for companies to think about implementation. It was written by a consultant, so it's like it's a really cool book in this day and age. So like if you're looking for something interesting right now, that's it. And then finance. Obviously I have the security analysis up there, but that's a little bit more intimidating. And if a book that I love and I give out to people all the time is The Little Book That Builds Wealth by Pat Dorsey. He has the foundational elements of how Morningstar built out their investment platform from a thought perspective, and how you outline things like economic moats and such. It's such a simple read. It's like reading a child's book, but also one that I think is as simple as it needs to be for investing. Just read that over and over again until it's second nature, and you could read that in a day or half a day, really. So I think those are the three books. The
Okay.
Tacopedia, though, can't beat tacos. So
Well, you never know. I mean, there could always be a nice opportunity to invest in a some sort of a company, right? Fast food
Chipotle,
chain of
man,
some sort.
one of our best
Right.
investments was Chipotle. I didn't bring it up, but that was
Yeah, that was a good one. I have to say, I've looked into Chipotle. I remember there was at some point I was reading an equity report by some of the one of the largest companies there, and they were valuing Chipotle, and I found it so ridiculous. They had some assumptions about the revenue growth and the profitability and all that stuff, and I thought that was all reasonable. Then they did that over the next 20 years. I said, okay,
20
all
years.
right, you could try to predict the next 20 years, fine. And then they attached a multiple of 60 times the price, the earnings in 20 years' time. So, well, okay, if you take an approach like that, you can make a case that any company is cheap, right?
Yeah, that's when
So,
like when they're starting to stretch a little bit, right? So like I remember during COVID, right, and valuations were getting excessive. We went from price to cash flow to price to earnings all the way quickly. Every company was being valued on a price to sales,
yeah,
and that's ultimately where companies are being valued at like 70 times sales. And some may grow into that. That's fine, but like, and then you look at
yep,
like I don't even want to name the company, but there's a company out there that's laid a 10-year revenue target of $10 billion. People will know who I'm talking about if they follow infrastructure software, but laid out a target of $10 billion. And I'm like, how do you know, like, how can you forecast 10
yep,
years out, especially as the company, and
yep,
actually lay that out? So it's definitely interesting to say the least. We don't
yeah,
go that far. We go 3 7 years, at most 7 years, and really try to sit around five. um,
yeah.
and that's even far. So
Yeah, I mean, generally the public companies have a vision of where they want to go, and they just focus on the really short term, what they can execute. So,
yeah,
and that changes anyway. I mean, even we as individuals, can we plan what we will do 5 years from now or 10 years? I mean, we could have a vision, right, where we would like to be, but the chances of that actually happening, yeah, we will be close maybe, but it's difficult to really forecast. You brought AI, and I mean, there's a lot of development there, not only in the form of software, but also robotics as well. I've been thinking recently about the impact of robots if they can replace certain jobs that are. I mean, this has been the discussions probably since the industrial revolution, where the machines are taking over the jobs. But I think the chances of that actually happening on a larger scale is much higher today than it was before. And it would be interesting to see how that develops over the next, I don't know, 30, 40, 50 years, if they're actually robots who can do majority of what we do as human beings. And if we have, I don't know, full self-driving for delivery of packages instead of having to have people do that, I mean, that would really impact a large percentage of the jobs out there. So it it's a different case to be made today, because the types of jobs that will be required to service those kind of vehicles, sort of it, I think it requires a bit more education than what was needed after the industrial revolution. um, I don't know if you have any thoughts on it. Maybe universal basic income would be an interesting subject that will spark again, that I don't know, everybody gets some sort of maybe not a significant payment to kind of go through life in that kind of scenario. And again, I'm referring not in the next 5 years, but maybe I don't know, 40, 50 years from now.
I mean, I have thoughts around like AI in general, less so on the universal basic income factor of it, but it's, I think, this is the first time where like, like the computer reasons somewhat, right? So like it's definitely a big step change. We've had AI for a long time. We've had a lot of automation and things like that. Things can like technology a year ago could automate tasks, and you had data mining and task mining. UiPath had task mining for the last several years at least, and it
Yeah,
would try to look at what you were doing and find repetitive things and functions, and then just replicate those for you and automate it, right? And a lot of that was AI. If you think of robotics, for example, walk into an Amazon warehouse and you can just see it, robotics at
yeah,
work. A lot of those are pre-planned, right? Like, so the generative aspect of what we're seeing today is it can start to think on its own feet or whatever, on its own wheels, where
yeah,
it can course correct. We've spoken to many companies where really around like software where code can start to heal itself. Where if your website is down, it can find the problem and fix the problem right then and there. There's going to be governance that's required around this. We've talked to another company that is building a governance platform around AI. So in that moment there where the AI, where your website goes down, it provides, it tells you the website's down. It gives you the, what the fix will be. Maybe it helps define what the fix is in our
yeah.
words, right? In our language. And then you approve it, right? And like, so AI's been here. Generative AI is the step change. That's where it makes like reasonable decision making on its own. That's the big change. That's going to proliferate into everything, right? To cars and planes, the computers we're using, into calendars, into everything. I'm a big believer that that will how that like the valuation and utility and all that is a whole nother question. How do you make money and all these other things? But it's definitely a large step change in how we'll all interact. And then what will that do for second order, third order effects like um, people with jobs and well being? I do believe that the world evolves, right? Like we don't stay static. Um, and that will lead to people creating like again this person that I'm referring to is making a governance platform around AI. If AI and generative AI didn't exist, this governance platform never would have existed. So this company is now building a company for this of a company that didn't exist 2 years ago, and all of a sudden you have a new industry that is formed. And you saw that with agriculture. You've seen that so many times. There's still a lot of warehouse workers despite Amazon's robotics happening. So I think the world evolves and changes, and people have to change with it, and they tend to. Um, so
When
it's
there's
kind of how
no
I think about
change,
it.
when there's no option, you have to change, right? I mean,
Yeah,
that's what we human do. Definitely, we adapt quite quick. Now you have a lot
definitely.
of passion for finance and of course in valuation and investing, and you read a lot of stuff. For those who are interested in this kind of stuff in finance, what would be your advice? And I'm not referring only to those who want to be part of investment firms. It could be just people who are passionate for this. Maybe they want to start a blog, maybe they want to start a YouTube video, maybe they want to do a podcast, whatever that may be. What would be your advice?
Yeah, immerse yourself in it. Just immerse yourself. Like listen to earnings calls, read 10Ks, write your thoughts on a blog. That's how I remember my early days. That's what I was doing. I had a successful blog called the Market Meter at the time, and that was my outlet for channeling some of my thoughts. And just immerse yourself in it. I think not enough people read 10Ks anymore, um, and listen to earnings calls and whatnot. So just immerse yourself in it. You'll learn, at the very least, outside of investing, you'll learn more about business and how businesses function. And you can then, in the real world, when I say real world, I mean like in your own town, start a business with at least some general knowledge of what PayPal is saying, how they want to run their business, right? And you get some ideas from that. So I think that's kind of it. How what like recommendations about getting started and taking it a little more serious, I guess.
Perfect. Thanks a lot for the advice. Where can people find you? Maybe we can wrap the conversation with this question. I think that you share a lot of high quality content, and of course, it's free for everyone to follow. So, to the viewers, listeners, I'll leave links in the description. But Sean, if you'd like to share some.
Yeah, we got a couple outlets, and I'll just quickly share them. So, like, if you think of like Twitter, obviously at underscore Sean David, SeanDavid. So at underscore Sean David. I post a lot there. LinkedIn too, so you can find me, Sean Emory. We have a last thing is our podcast, Inside Scoop, or our YouTube channel, Avory Co. So Avoryco. We just post a lot of good stuff, like not the quality of Costa, but
No, no, no.
yeah. But we post a lot of
That's
stuff
a
there
start.
that's totally different from this. We bring on like CEOs and founders and such, so of like companies. So, but love what you do, and yeah, that's where you can find us.
Thanks a lot, Sean. I'd like to thank you for your time, and we'll for sure keep in touch. To the viewers and listeners, thank you for sticking until the very end. As always, I'll see you in the next one.